Yeah, I think as long as households in India stay committed to equity markets, and what is cheering for us, heartwarming for us, is that this cycle so far, although there has been some volatility, retail investors have continued to invest, which shows that they do believe that as we are in an economy which is growing at 7% or more, inflation is coming down, so we have a potential rate cut in the next 12 months or so. Fiscal deficit is under control, and we are seeing healthy FDI flows, modest to healthy FDI flows. We are still in a very good position. So I've not seen any sign of a slowdown in household savings, if you like, continuing to come into asset management mutual fund industry, and I expect that to continue over the next year.
And would the EPFO now finally, after a long debate, allowing 5% of its corpus to be invested in the equity markets via the mutual fund route, be the next game changer when it comes to giving the much needed balance, as we always have been a FPI or FII skewed equity markets?
Yeah, I think the advent of pensions liberalization and liberalizing the investment pattern that pension funds can utilize is a very big step. I think we are starting in a small way because as of now EPFO has said it will start with 1% and build to 5, although the government regulations say it can go to 15. But naturally their trustees remain quite cautious. Nevertheless, having said that, even starting with 1 and building to 5 will be a very material ballast and foundation for our equity markets, and we see that as positive. We also believe other similar pension funds and trusts will follow suit. So it's not just the EPFO, they will set an example for many other similar funds, and that's a very positive sign indeed.
And my last question, sir, is what we are witnessing, the Greece crisis, and RBI keeping a very hawkish eye on how macroeconomy is positioning, how world would see Greece, how the US Fed is going to treat things. How do you look at the macro situation panning out in India with various global factors panning out in their own way?
I think we are doing what we need to do to strengthen our own macroeconomic foundation, and the RBI has done a remarkable job over the last 12 months of stabilizing our currency, providing transparent frameworks for the way interest rates are going to be set, which I think is the right thing to do in terms of monetary policy framework. And I think it is doing everything it can to strengthen and stabilize the banking system as well. And the government, for its part, has been managing the fiscal deficit responsibly, and the current account deficit has resolved itself partly due to the price of oil and commodities. So frankly, we are in a pretty strong situation as a country today in a macroeconomic sense. Now, that may still not fully insulate us from the impact of genuine global dislocation, as you will see risk aversion rise and global investors start to reallocate both bonds and equities away from emerging markets. So yes, of course, India has to be mature enough to accept that we will feel some impact of that. At this point, my sense is long-term investors will stay put on the whole. But we must be prepared for a little bit of volatility and not overreact to that. The long-term commitment to India is very strong on the part of global investors at this point.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.